Yesterday I showed you this Roth IRA that I created in 2004 through 2024 that yielded about a $4.2 million return on investment. And what I did was invest in the growth opportunity that I saw in 2024, and that was of the digital revolution. And I chose four stocks: Apple, Microsoft, Amazon, and Google. And then I dollar cost averaged into them over the 20 years of $1,500 into a Roth IRA into each one of them. So an annual contribution of $6,000. But what I want to tell you is it's not just that simple. It's also not only what do you buy, but when do you buy it? Do you buy it at the first of the year? Do you buy it at the end of the year? Do you dollar cost average in on a monthly basis? I'm telling you, if you'll do a little research, you can more than double, in some cases, the return on your investment, not only in what you buy, but when you buy it. Let me take you to my computer and let me show you the research that I've done on Apple so that I can emphasize to you and train you on it's not only what you buy, but it's when you buy it. Let's take a look at this. Okay, this is the Excel spreadsheet that I created and tracked the Roth IRA from, as you can see, 2004 to 2024 on Apple, Microsoft, Amazon, and Google. And what I'm showing you here is a contribution of $1,500 into each one of these stocks on an annual basis from 2004 to 2024. But and what this is based on is their annual return. But what I want to show you is that when you buy is almost as important as what you buy. So over here, I'm going to analyze in detail, do a deep dive into Apple and show you exactly what happens. This is the average stock price for 2004. This is the open for the year, the high for the year, the low for the year, the close for the year, the annual change. I'm investing $1,500. If I buy it at the high, $1.03, I'm going to buy 1,453 and a half shares. If I buy it at the low, though, of 32 cents, I'm going to buy 4,674 shares. If I buy it on the average, that's going to be at 53.5 cents. I'm going to buy it at 2,800 shares. Now look at the difference in the number of shares that I'm buying. A low at the high of 1,400. At the average, I double the number of shares that I get of 2,800. And if I can buy it at the low, I go from 1,400 to 4,600. Now, why is this important? It's important because when I get down here at the bottom and the share price is $200, here I have twice as many shares or 3.5 times as many shares to multiply times that 200 than if I buy it at the high. Okay, does that make sense? We want to buy more shares. So really, if you look at it realistically, the best thing that could happen is that I buy at the low in 2004 at 32 cents, and it doesn't move. It doesn't move until 2024 when it opens up the year at 184. It hits a high of 236, and it gets an average of, or the close of 230. So think about that. I would be every year, I would be buying 4,670 shares times 20 years. I'd have a massive amount. And then if it just went right to $200, it'd be unimaginable. So it becomes important as to when I buy. So how can I figure out when should I buy? Well, I think we can see some patterns. When the stock has a good year, and how will we anticipate this year or this change? We'll see that Apple is projecting a growth in their revenues and a growth in their earnings, which gives us indication that where their price is going to go up that year and the years that they're showing an increase in price. And we don't see any economic headwinds that they might have to deal with. So if we look at this and we say, okay, up 200% the following year, we probably need to buy at the open. Okay? Here, the low was 115, $1.52. The high was $2.55, and the open was 225. So again, if I don't know what the low is going to be, anticipating a good year in front, I need to probably buy at the open. Again here. But then look at this. We see in 2008, this would be kind of the beginning of the subprime crisis. We have some economic headwinds. We recognize that maybe as we go through the year, it's going to be a tough year. So we don't want to buy at the open, which happens to be the high, and we're probably going to be better off if we buy at the close. Then recognizing the projections for the coming years, we see that the future years look very, very strong there. Again, how do we know this? We go to our predictions, and I'll show you exactly where we go, what the earnings are going to be, what the revenues are going to be in the future. And with that in mind, we look to buy more in likelihood at the open rather than the close. Now, the other option is we can achieve the average just by putting something in every month. And if that's okay, if we're okay that we end up with $1.5 million as opposed to 2.3, but much better than 947, that's a good plan. Okay, all it takes is a plan up front. Am I going to try to anticipate based on market conditions and projections? Am I going to try to predict when the high and the low are going to be, or am I just going to buy the average? Okay, so with this in mind, you can see the patterns. When bad years occur, and we can anticipate those bad years, we need to buy probably at the close. Again, a bad year, we probably need to buy at the close. A bad year, buy at the close. Buy at the close. Now, again, I told you I'd give you some clues as to how you can anticipate those red numbers, those annual changes that are negative. What we do is we go and look at our projections. Let me take you there. This is where I go. This is my Seeking Alpha. I subscribe to it, and I share these numbers with my tribe members. So what I do is I go here to earnings, and then I go to earnings estimates, and I come down here and say, okay, what is Apple telling me the price is going to be relative to their earnings and their revenues? Well, if I'm right now in 2024, the end of October, they're telling me that they're projecting that their earnings are going to go up 11.4% in 2025, 12.8% in 2026, and 25.43% in 2027. So in absence of any headwinds, I see green numbers, not red numbers, but green numbers in Apple's price in the next 3 years. Until something tells me different, I want to buy into my Roth IRA at the open, on January the 2nd, 2024. If I see it going down, then I'll go the other direction. So let's look then at revenues and see if we see a confirmation that Apple is anticipating some growth, 7% in 25, 8% in 26, and 12% in 27. So again, if I go back to my chart, I'm anticipating for Apple a green number. Let's go over here and look at it. A green number in 2025, 26, and 27. And if I look over here, that tells me the odds are in my favor if I buy at the open. January the 2nd, 2025, 26, 27. And I look at that and keep up with it, and I do it on Microsoft, Amazon, and Google. To use a poker analogy, I've stacked the deck in my favor. Now, again, you need to recognize what I've identified, first of all, is a growth opportunity. And that opportunity, I believe, is big tech investing into Jensen's GPUs and all the technology that is going to deliver artificial intelligence to you and I and everybody in the world. And it's going to dwarf the growth of the digital revolution, because again, it's going to bring all the knowledge in the world to us. Now, how is that going to make us better? It's going to make us much more efficient at our work. It's going to change our health entirely, in that we will have all the knowledge in the world about cancer, about heart disease, about AFib, about whatever is happening. And it will be cued to our watch, which will be cued to our phone, which will be cued to a database, and we will have instantaneously a diagnosis of what's happening to our health. Now take that whole thing and say, okay, let's apply that to our business. An instantaneous diagnosis to the health of our business, to the workings of our automobile, to the workings of our body, to the workings of anything and everything, the solar system, whatever. It's all the knowledge will be there. And it's going to be delivered to us by just a few companies. So what we want to do is expand upon our 2004, 2024 Roth IRA, bring in some other players, and then keep up with it on a day-to-day, month-to-month, week-to-week, year-to-year basis, so that we grow with the best, so that we understand the way to make money in the stock market is not to collect dividends. It is not to put in the old sage companies. It's to recognize the growth opportunities, identify what a company does to participate in that growth opportunity. What do? They create new products. In order to create a new product, what do you have to do? You have to spend money to make that opportunity available to you. And in many cases, you have to hire more people, or not hire more people because you're using artificial intelligence, and stay attuned to it. What's going to deliver this? Semiconductors. So we can narrow our focus down. We can track the movements of the stocks. We can determine not only what to buy, but when to buy. And doing this together, we can succeed. What do I mean by together? I mean, get on the bus. What is it? We're up to about 1,000 people who put their heads together to say, how can we make better investment decisions? Kerry, we'll fund you to go do all the research. And you put these things together because you like to do it, Kerry. We don't want to do it. You do it. You go hire the people, that the computer scientists that can not only do this for the 42 stocks that you track in the semiconductor and the artificial intelligence, but every other element of the market. And let's grab that artificial intelligence that's going to change our world and bring it into focus on our investment decisions. And let's do it together. Let's take on Wall Street. Let's level the playing field and go head to head. I'm Kerry Grinkmeyer. I'm a retired financial advisor. I'm having the time of my life. I invite you to join. Come to the website. Here are our levels that you can enter as cheap as $9.99 a month. You'll find out if it's comfortable, if it's good for you. See if we can't educate you to make better investment decisions. And I'll be damned, maybe even create some family wealth. Maybe even become a 1%er, because that's what the people in the United States who are considered wealthy are, 1%ers. So let's you and I become 1%ers by working together.